Welcome back to the deep dive. This is the place where we take on, well, really complex financial topics, piles of research, and sometimes confusing global systems, and we try to boil them all down into the essential knowledge you can actually use.
And today, we're definitely tackling a big one.
The big one, the single largest, most consequential financial obligation most of us will ever take on in our lives, the mortgage.
It's truly ubiquitous, isn't it? It's the main way private home ownership is funded in, well, pretty much every developed and developing country.
But, and this is what really struck me in the sources you shared, the terms, the risks, the actual legal structures behind it all, they vary so wildly. I mean, buying a home in suburban America is a completely different ballgame from getting a condo in Toronto or a flat in Berlin.
Completely. And that's our mission for this deep dive. We want to simplify what can be, frankly, an overwhelming amount of terminology. We're going to look at the precise math, the legal concept, everything behind this huge secured loan.
Right, and we're really going to focus in on how lenders figure out risk, and I think this is the crucial part, how different global systems manage that risk, because those differences can fundamentally change the entire experience for you, the borrower.
And we're going to start with maybe the most striking, and I have to say slightly morbid, historical fact about this whole instrument.
Okay, I'm intrigued.
We all call it a mortgage, but you really need to understand its ancient and slightly terrifying origin story.
Let's unpack that. The word mortgage, it's not just some, dry financial term.
Not at all. It comes directly from law French, which was used in Britain back in the Middle Ages.
And the translation is?
Death pledge.
Death pledge. Okay,
Yeah.
That sounds a lot less like a friendly bank product and more like something out of a medieval contract you really don't want to sign.
It is intense, right?
Yeah.
But the name gives us this immediate insight into the seriousness of the commitment. Historically and legally, the term refers to the pledge itself, the promise ending, or, dying.
Okay, so the pledge dies. How does that happen?
In one of two ways. The first way is the good way. The borrower fulfills the obligation, pays off the debt, and the pledge dies a successful death. It's over.
And the second way?
The second way is that the property is taken by the lender through foreclosure. The pledge dies a failure. But in either case, the commitment is extinguished, it's dead.
That really frames the whole relationship right from the start, doesn't it? This is not just a personal loan based on your good name. It's something much, much more fundamental.
Exactly. At its core, a mortgage is a loan that is secured directly on real property, and that gives the lender something called a lien.
A lien. Break that down for us.
In simple terms, a lien means the lender has a legal first priority claim over that property if you, the borrower, default. They get paid first before any other creditors. It's a foundational legal concept.
And this isn't just an American or British thing.
Oh, no. It's so pervasive that in, say, civil law jurisdictions, think continental Europe, Latin America, this kind of loan is often called a hypothec loan.
A hypothec loan.
Yeah, different name, but the mechanism is identical. You provide the collateral, the property, in exchange for the loan, and that collateral provides the security for the lender.
So when we look at the components, we're dealing with a pretty standard cast of characters, financially speaking.
We are, although their roles have gotten incredibly complex in modern finance.
Okay, so let's start with the basics.
You have the borrower, who in legal terms is the mortgager. That's the person creating the security interest.
And then the lender.
The mortgagee. Typically a bank or some other financial institution. But here's where it gets interesting, especially in huge markets like the United States. The lender who actually originates the loan, the one you sit down with, they often don't keep it.
They sell it. So you start with what's called a loan originator, but the actual asset, the legal right to your future stream of payments, gets packaged up and sold off to investors?
Precisely. Through a process called securitization. This means a third or even a fourth company often gets involved. The loan servicer.
And that's the company that sends you the bill every month.
That's the one. They collect the payment, they handle your escrow for taxes and insurance, and they manage the day-to-day stuff with you, the borrower, but they're doing it on behalf of the investors who now actually own your loan.
I can see how that could get complicated. I remember during the 2007 crisis, that splitting of interests became a huge problem when the paperwork got messy.
A massive problem. And the way these loans are funded reflects that complexity. You noted there are two main ways all this money gets generated.
Right.
Some mortgages are funded the old-fashioned way, through the banking sector. A bank takes in customer deposits and lends that money out.
But that can't possibly be enough to fund the entire global housing market.
Not even close. The vast majority of the capital, the trillions of dollars needed, comes from the capital markets through that process we just mentioned. Securitization.
So that's taking pools of what? Thousands of individual mortgages?
Thousands, yeah. And converting them into standardized fungible bonds. You've probably heard of them, mortgage-backed securities. These can be sold to pension funds, insurance companies, global investors, you name it.
And that's what keeps the whole system liquid. It lets banks get the loans off their books so they have new capital to lend out again?
It's absolutely essential.
Yeah.
And this entire structure, this whole edifice from that medieval death pledge all the way to a modern securitized bond, it all hinges on one single thing.
Risk.
Risk.
Yeah.
How risky is this specific borrower? How risky is this specific property? Which brings us right into our first big section, the anatomy of risk.
Okay, so the underwriting process. This is basically the lender's machine for figuring out and managing all these different kinds of risk.
Exactly. You can think of it as three intertwined risks they're trying to quantify.
Mm.
The risk of the borrower, the risk of the collateral, the house itself, and the broader market risks like interest rates changing.
Let's start with the borrower. We've all heard the term mortgage underwriting. It sounds formal, bureaucratic. What is an underwriter actually doing all day?
Their job is verification. But it's so much more than just ticking boxes. They're trying to assemble a complete, verified financial portrait of you.
So they're looking at my income.
Your income consistency, your employment stability, a very detailed credit history, and crucially, making sure the source of your down payment is legitimate and seasoned.
What does that mean, season?
It means it's been in your bank account for a while, usually a few months. They want to make sure you didn't just get a short-term undocumented loan from a relative last week just to qualify. The process is meticulous. The underwriter is basically trying to answer one question. Is this person going to perform as expected for the next 30 years?
And buried in our source material, there's some really critical practical advice for anyone going through this process. It speaks directly to what that underwriter is looking for.
It does. The golden rule is simple.
Mm-hmm.
Do not rock the boat. That period between your application and the closing is a very delicate financial time.
What do you mean by rock the boat?
Any major change to your financial profile. So no opening new credit cards, no taking out a new car loan, and this is a big one, no changing jobs.
Wait, not even for a promotion?
Not even for a promotion with a pay raise, because it interrupts the stability of the employment history they just spent weeks verifying. Any one of those things could trigger a complete reassessment, or worse, get the loan denied right at the last minute. You want the underwriter to see total, unwavering stability.
Okay, that makes sense. Let's move from the person to the collateral itself, the property. This is the lender's ultimate safety net. If you default, they seize it and sell it. But how is value actually determined? The sources list 3 different ways, and they're not always the same number.
And that non-alignment, that difference, is a key point of vulnerability in real estate markets.
So what's the first one?
Their first is the simplest, the actual or transaction value. It's just the price you and the seller agreed upon. That's the starting point.
And the second?
The appraised or surveyed value. This is a non-negotiable legal requirement in most places. A licensed professional appraiser has to come out and provide an objective third-party estimate based on recent comparable sales, the condition of the property, its location, and so on.
And then there's a third type of value, which shows that lenders don't just passively accept these outside reports. They do their own homework.
That's right. It's the estimated value. Lenders have their own internal models, often proprietary and automated. They're called AVMs, automated valuation models. They use these to calculate their own estimate, either to cross-check the appraiser's number or in places where a formal appraisal isn't standard.
And what happens if those numbers don't line up? Let's say I agree to buy a house for $500,000, but the appraisal comes in at $480,000.
That is a major red flag for the underwriter. The lender will almost always use the lower the transaction price or the appraised value to make their loan calculation. So in your example, they base the loan on the $480,000 value, which might mean you need to come up with an extra $20,000 for your down payment, or the deal could fall apart.
Wow. Okay, so once they have that confirmed value, they apply what seems to be the single most critical metric for collateral risk, the loan-to-value ratio, or LTV.
LTV is the primary risk indicator for the collateral. And a really simple ratio, the size of the loan versus the confirmed value of the property.
So if I borrow $80,000 for a $100,000 home, my LTV is 80%.
Exactly. And the higher that LTV, the higher the risk for the lender.
Why is that risk so nonlinear? I mean, a 95% LTV doesn't sound that much riskier than an 80% LTV, just looking at the numbers.
It's all about what's called the equity buffer.
Mm-hmm.
At 95% LTV, you, the borrower, have only 5% equity. You have very little skin in the game.
Right.
This means that even a small dip in housing prices, say 6%, immediately pushes your loan into negative equity. You're underwater.
You owe more than the house is worth.
Precisely. And if the lender is then forced to sell that house quickly in a foreclosure, there's a catastrophic risk that the sale price won't be enough to cover the remaining debt, not to mention all the legal costs of the foreclosure itself.
But a lower LTV, say 60%, gives them a huge cushion.
A massive margin for error, even if the market gets stressed. This is exactly why 80% LTV is that magic threshold where we see things like the requirement for mortgage insurance kick in. It's the line where the bank feels the risk level becomes acceptable.
Okay, that's the house. Now let's switch back to the person living in it. The borrower's capacity to actually make the payments. We're talking about debt ratios.
Yeah, now we need to make sure the borrower isn't over-leveraged, that they can handle the payments and still, eat.
So what are the metrics here?
There are two common ones. The first is payment to income. That's just the mortgage payment as the percentage of your gross or net income. But the much more stringent measure is the debt-to-income ratio, or DTI.
And DTI is the big one.
It's the all-encompassing one. It takes your total proposed mortgage payment principal, interest, taxes, insurance, and adds it to all of your other required monthly debt payments.
So car loans, credit card minimums, student loans.
Everything. And it calculates that total debt load as a percentage of your total verifiable monthly income. DTI is often the final hurdle.
It was fascinating to see in the source material that this ratio isn't just a marker of financial risk for the bank. It's also correlated with psychological health. The underwriter is basically measuring your future stress level.
Yes, that was a specific finding. Higher DTI ratios have been associated with heightened psychological stress in borrowers. And that just underscores that these numbers aren't just, abstract figures for a bank spreadsheet. They reflect a real burden on a person's well-being and stability.
And from the lender's point of view, a highly stressed borrower is a higher default risk. The two are completely linked.
Absolutely. They're underwriting for human stability just as much as they're underwriting for financial capacity.
All this precision and all these rules lead to a really important concept, especially in markets like the U.S., the standard or conforming mortgage.
This is a foundational idea. A conforming mortgage is one that defines a universally accepted and therefore highly desirable level of risk.
What makes it conforming?
It has to adhere to these really rigid guidelines set by major government-sponsored entities, or GSEs, like Fannie Mae and Freddie Mac in the U.S. The source cites the standard benchmarks. Having an LTV no higher than, say, 70 or 80%, and a total DTI that doesn't go over about 36 to 43% of your gross income.
So if my loan application fits neatly inside that box, what does that mean? What's the consequence?
The consequence is liquidity. If your mortgage is conforming, it's easily eligible for purchase by Fannie or Freddie. That means the originating bank knows they can sell it into the secondary market immediately.
Which gets them their cash back to make the next loan.
Instantly. And that efficiency drives the whole market. It generally results in lower interest rates for you, the borrower, because your loan is seen as a safe, standard, easily tradable product.
So what about the loans that don't fit in the box, the non-conforming ones?
Well, a lender who makes a non-conforming loan is taking on more risk themselves. These could be jumbo mortgages, which are just too big to meet the GSE size limits, or subprime loans for borrowers with, say, poor credit histories or high DTI ratios.
And because those loans can't be easily resold to Fannie or Freddie,
the originating lender has to either keep it on their own books or find a specialized buyer. They're assuming higher risk. So to compensate for that, they charge higher interest rates and often demand stricter terms, like a bigger down payment. The market literally prices that extra risk directly into the cost of your loan.
Before we move on from underwriting, there was one last thing that I found really interesting, a lesser-known requirement called reserve assets.
Ah, yes. This is a brilliant underwriting tool. It's a critical safety buffer against short-term volatility.
So what is it?
Lenders require some borrowers, especially those with slightly riskier profiles, to prove they have enough liquid funds available in a checking or savings account to cover their total housing costs for a few months.
Their mortgage, taxes, insurance.
Exactly. For one or more months, even if they were to suddenly lose their job or have some other short-term income shock.
So it's basically the lender demanding to see your personal break glass in case of emergency fund before they'll give you the loan.
That's a perfect way to put it. They're underwriting against temporary unemployment. which statistics show is a major trigger for people falling behind on their payments for the first time. For investment properties, this requirement can be even stricter, sometimes 6 or even 12 months of reserves. It ensures you have a cushion to weather a storm without immediately threatening the bank's collateral.
That is a really comprehensive look at how lenders decide who gets the money. But now let's shift gears. Once you're approved, how do you actually pay this death pledge down? Let's get into the repayment structures because the standard monthly payment is far from the only game in town globally.
Right, and the dominant model, certainly in the US and the UK, is what's called the fully amortizing loan.
Our source mentioned it's called a repayment mortgage in the UK and self-amortization in the US.
Different names, same idea. It means your periodic payments, usually monthly, are calculated with mathematical precision so that over a set term, say 30 years, the entire principal balance and all the interest are paid down to zero.
So the monthly payment stays the same, assuming a fixed interest rate.
Correct. And the 25 to 30-year terms are the most common in the English-speaking world. It's a balance between making the monthly payment affordable and managing the total amount of interest you'll pay over the life of the loan.
But that fixed payment structure creates something that I think catches a lot of first-time borrowers by surprise. It's that famous annuity effect. You make a $2,000 payment, but in the first year, it feels like only a tiny fraction of that actually goes to paying down your loan balance.
It is a common shock. A mortgage is structured as a decreasing annuity. Because interest is charged on the outstanding principal, your early payments are overwhelmingly weighted towards interest, sometimes 80% or more in the first few years of a 30-year loan.
So most of your money is just servicing the debt.
In the beginning, yes. But as the years go by and you slowly chip away at the principal, that ratio starts to shift. More and more of your fixed payment goes toward reducing the principal balance itself, and less goes to interest.
Which is why making extra payments early on in the loan is so much more powerful than making them later.
Absolutely. You're attacking the principal when it's at its largest, which eliminates years and years of future interest that would have accrued on that money. It's all driven by a specific mathematical formula.
Okay, this is where we get into the technical deep dive that our audience loves, the amortization formula. This is the engine under the hood of every standard mortgage payment.
This is the key. The formula calculates the precise periodic payment, which we'll call A, that's required to fully pay off the loan. It'll look a little intimidating, but it's quite elegant. It's A equals P times, a big fraction.
Let's break down the variables in that formula so it's not so intimidating.
Okay. P is just the principal, the amount you borrowed.
Simple enough.
R is the rate of interest per period. And this is key. If you have an annual rate but you're making monthly payments, you have to divide that annual rate by 12 to get R.
Got it. And the last one?
And it is the total number of payments. So for a 30-year loan with monthly payments, it would be $360. You plug in those numbers, and the formula spits out the exact payment you need to make to ensure the debt is cleared on the exact end date.
And whether that rate changes or not is the defining difference between the two major types of loans.
Correct. You have the fixed rate mortgage, FRM, which is the gold standard for safety in the U.S. The interest rate is locked in. It stays constant for the entire life of the loan, giving you absolute certainty.
And then you have the adjustable rate mortgage, ARM, which completely flips the risk equation.
It really does. With an ARM, the interest rate adjusts periodically, maybe once a year, to follow some external market index. The crucial thing to understand here is that an ARM transfers the interest rate risk from the lender to you, the borrower.
And because the lender is now protected from rising rates, they give you a better deal up front.
Exactly. The initial rate on an ARM is often significantly lower, maybe half a point to 2 full points below a comparable fixed-rate loan. It's an incentive to entice you to take on that future risk.
But that low initial teaser rate doesn't last forever.
No, and that's where the danger of payment shock comes in. Many ARMs are structured as 51 or 71, meaning the rate is fixed for the first 5 or 7 years, and then it starts adjusting every year after that. While they usually have caps on how much the rate can jump in 1 year, that first adjustment can still be a huge shock to your budget if you weren't prepared for it.
Moving on to even riskier strategies, we have interest-only mortgages. The sources link these directly to housing crises and regulatory crackdowns.
They are inherently much higher risk because they violate the core principle of amortization. With an interest-only loan, your monthly payments are only covering the interest. The principal balance doesn't go down at all.
So how do you ever pay the house?
Well, the idea was that you would simultaneously make separate regular contributions to an independent investment plan, like an endowment policy or a savings account. And that plan was supposed to grow into a big lump sum, big enough to pay off the entire principal in one go at the end of the term, 25 or 30 years later.
You're basically making two bets at once, one on the loan and a completely separate speculative bet that your investments will perform well enough for 3 decades to cover the entire cost of your house. What could possibly go wrong?
And it failed spectacularly, especially in the UK, where these were very popular for a time because of certain tax advantages. Many borrowers either didn't set up a repayment vehicle at all, or, more often, the investment just performed poorly.
So the maturity date arrives.
And they find themselves with a £200,000 debt and only $100,000 in their investment account. They faced immediate default.
And this led to a big regulatory intervention from the UK's Financial Services Authority, the FSA. What did they clamp down on specifically?
Their big concern was that mismatch at maturity.
Yeah.
So they forced lenders to prove that the borrower had a credible and verified repayment strategy.
Yeah.
Lenders couldn't just assume an investment would grow at 8% a year anymore. They had to stress test it, project conservative growth, and make sure the borrower knew the risks. It became so onerous that many big lenders just pulled out of the interest-only market altogether.
Now let's look at the complete opposite of a traditional loan, the reverse mortgage. This is where your debt actually grows over time.
Right. This is a form of equity release aimed at older borrowers, typically retirees, who are house rich but cash poor. They have a lot of equity in their home, but not much monthly income.
And how does it work?
The mechanism is unique. You don't make any payments, principal, or interest. Instead, the interest just gets added to the principal balance each year. The total debt grows over time, eating into the homeowner's equity.
And the borrower literally never has to make a monthly payment.
That's the entire appeal. The loan only becomes due when a triggering event happens. The borrower passes away, moves out of the home permanently, or maybe fails to pay property taxes or insurance.
In the U.S., the government has a big program for this, right?
Yes, it's heavily regulated and insured through the HECM program, the Home Equity Conversion Mortgage. And it's very flexible. You can get the funds as a lump sum, as a monthly payment for life, or as a line of credit you can draw on when you need it. It solves a real cash flow problem for seniors.
Okay, before we go global, let's quickly touch on some of the hybrid types that blend these structures.
There are a few interesting ones. Graduated payment mortgages are designed for young professionals who expect their income to rise. The payments start low and then increase over time, matching their presumed career trajectory.
And then there are balloon loans. These sound scary.
They are high risk. You make small payments for a set period, but then the entire remaining principal balance is due all at once as a huge lump sum, the balloon payment, long before the loan would have naturally amortized. You either have to have the cash or be able to refinance, otherwise you face foreclosure. They're mostly used in commercial real estate.
That covers the core mechanics of how you pay. But as we said at the beginning, the rules and regulations around these products vary dramatically from country to country. Let's move into our global exploration.
This is where you really see how national priorities around risk, consumer protection, and even the government's role in the market shape everything.
Let's start with the United States. The source material points out a key structural quirk. There are two separate legal documents involved.
This is fundamental to U.S. mortgage law. You have the mortgage note, which is the promissory note. That's your actual IOU, the promise to pay the money back. It represents the debt.
Okay. And the second document?
That's the mortgage document itself, which is the security instrument. That's what gives the lender the lien on the property. It represents the collateral.
That separation seems like a small detail, but why did it become such a massive problem during the 2007 crisis? The phrase, "show me the note," became a rallying cry.
Because with all that rapid securitization, those two documents often got separated. The electronic note was bundled and sold over and over, while the physical mortgage document might be sitting in a file cabinet somewhere else entirely.
And the law says?
The law says the holder of the note, not the mortgage document, have the right to foreclose. When the documentation got lost or messy, which happened all the time, the company trying to foreclose couldn't actually prove they had the legal standing to do so. It created this huge legal bottleneck in the system.
The U.S. mortgage sector also just seems to be historically volatile.
It is. It's been the epicenter of several major financial crises. You had the national mortgage crisis in the 1930s, which led to the creation of the FHA and Fannie Mae, then the savings and loan crisis in the 80s and 90s, and of course the 2007 subprime crisis. The sheer scale and complexity of the U.S. market makes it uniquely prone to these systemic blowups.
Okay, let's head north to Canada. They seem to have a much more conservative approach with a powerful policy body, the CMHC.
The Canada Mortgage and Housing Corporation. Yes, they are the national housing agency, and they really shape the market. And their standard product is very different from the U.S. The most common mortgage in Canada is the 5-year fixed-rate closed mortgage.
A 5-year term, not 30. And what does closed mean in this context?
A closed mortgage severely restricts your ability to pay off the loan early or refinance without paying some pretty substantial penalties. It's a stability mechanism for the lender.
Whereas in the US, most 30-year loans are open, meaning you can pay them off whenever you want with no penalty.
Exactly. The Canadian system prioritizes lender stability and predictability, whereas the U.S. system prioritizes borrower flexibility.
Now, Canada got through the 2007 crisis relatively unscathed, but they still took a huge regulatory step in 2016 to stop their own market from overheating, the famous mortgage stress test.
This was a really proactive and very controversial move. The policy requires every single home buyer in Canada to qualify for their mortgage, not at the interest rate they're actually being offered, but at a much higher stress rate set by the Bank of Canada.
So walk me through that. I could be offered a loan at 3%, but they test my affordability as if it were.
Yeah, it's if it were, say, 5.25% or your contract rate plus 2%, whichever is higher. The idea is to ensure you can still afford your payments if interest rates rise significantly by the time your 5-year term is up for renewal.
And the goal was to cool down housing prices. What was the actual effect?
It was immediate and powerful. It reduced the maximum loan amount people could qualify for by up to 20%. It definitely cooled the market and curbed household debt, which was the goal. But it faced a huge backlash from the real estate industry, who argued it was unfairly locking first-time buyers out of the market. It's that classic tension between stability and accessibility.
Okay, let's cross the Atlantic to the UK and continental Europe. The UK market used to be dominated by building societies.
It did, but banks have become the major players since the 70s. A key difference from the U.S. is that variable rates are much more common in the UK, partly because their mortgage financing relies less on fixed-income securitized assets and more on traditional retail savings deposits.
And when we look across the rest of Europe,
It's a real mix. Countries like Germany, Denmark, and France strongly favor fixed rates, while places like Spain and Italy lean more towards adjustable rates. But a key structural difference in a lot of European finance is the reliance on something called Pfandbrief, or covered bonds.
covered bonds. How do those provide stability in a way that, say, U.S.-style mortgage-backed securities don't?
A covered bond offers what's called dual recourse. The bond is backed by two things. First, the pool of mortgages themselves, and second, the full balance sheet of the issuing bank.
So if the mortgages go bad.
The investor still has a direct claim against the bank itself. The pool of mortgages is also legally separated from the bank's other assets, so it's protected in a bankruptcy. This makes them inherently safer instruments, and it's a big reason why European default rates tend to be lower and their markets more stable.
Finally, let's turn to one of the most unique models born from religious principles, Islamic mortgages. The core challenge is that Sharia law prohibits charging or paying interest, or riba.
It's a profound challenge because a mortgage is, by definition, an interest-bearing loan. So Islamic finance had to completely re-engineer the transaction to avoid riba. They're often structured as a partnership or a deferred sale. The property actually changes hands twice.
Okay, walk us through the first model, the deferred sale.
That's called buy bithman ajil, or BBA. In this model, the bank first buys the property you want, outright, from the seller. Then the bank immediately sells it back to you, the borrower, but at a much higher pre-agreed price, which you pay off in installments.
So the bank's profit is built into that marked-up sale price, not charged as ongoing interest.
Exactly. It's a sale premium, not interest on a loan. It's a completely different legal and religious structure.
That's ingenious. What about the partnership model?
That's Musharaka Mutonakisa, or MEM, which means decreasing partnership. Here, the bank and the borrower buy the property together. Let's say the bank puts in 80% and you put in 20%.
So you're co-owners.
Right. And then two things happen every month. First, you pay the bank rent for using their 80% share of the property. Second, a portion of your payment is used to buy out a little bit of the bank's ownership share.
So it's kind of like a rent-to-own scheme. Every month, your ownership stake goes from, say, 20% to 20.5%, and the bank's goes down.
Precisely. The bank profits from the rental income. And over 25 years, You slowly buy them out until you own 100%. It's a decreasing partnership.
But our sources noted this can run into a really practical and expensive legal problem. Stamp duty.
Yes, stamp duty is a transaction tax charged when property changes ownership. And in these structures, ownership changes hands twice, once to the bank and then gradually back to you. So you could get hit with that tax twice, making the whole thing economically unworkable.
And what's the solution?
Well, in places like the UK, they just changed the law. The Finance Act of 2003 specifically removed that dual application of stamp duty for these transactions. It was a deliberate policy move to facilitate Islamic finance, showing how legal systems can adapt.
We have covered so much, from approval to amortization to global variations. Now we have to talk about the worst-case scenario, default. This brings us to foreclosure and the safety nets put in place.
Foreclosure is the final act of the death pledge. It's the legal process that allows the lender to seize and sell the property if the borrower fails to meet the terms of the loan.
And like everything else we've discussed, the process is not at all standardized.
Not even close. It varies enormously. Some places, like certain title theory states in the U.S., allow for rapid, non-judicial foreclosure. The lender can sell the property in a matter of months without much court oversight.
But in other places, it's a much longer, more difficult process.
Right. In Lehman theory states and many European countries, it's a highly regulated judicial process that can drag on for months, sometimes years. And the sources note that if it's too hard for lenders to foreclose, it can actually stifle the development of a mortgage market because the risk is seen as too high.
This leads us to what might be the single most important distinction for a borrower's ultimate liability: recourse versus non-recourse debt. This one legal detail determines your financial fate if the house sells for less than you owe.
Every borrower needs to understand this. It is fundamentally about who bears the final risk. Let's start with non-recourse loans. With a non-recourse loan, if the forced sale of your property doesn't bring in enough money to cover the outstanding debt, that shortfall is called a deficiency, the lender has no recourse to come after you for the rest of the money.
So let me get this straight. In a non-recourse state, if the market crashes and I owe $200,000, but my foreclosed house only sells for $150,000, that remaining $50,000 debt is just gone.
It's gone. The debt dies with the property sale. The bank takes the loss. This is common in certain U.S. states that prioritize debtor protection. The lender bears the market risk. And it changes borrower behavior. In the 2007 crisis, millions of people in non-recourse states did what was called a strategic default. They just walked away.
But the sources are clear that this is not the norm. Recourse loans are much more common globally.
They are the standard pretty much everywhere else. The UK, Canada, most of Europe. In a recourse system, the borrower remains legally responsible for that deficiency.
So in that same scenario, the bank could get a deficiency judgment against me for that $50,000.
Yes. And they could then pursue your wages, your bank accounts, or other assets to get that money back. It completely changes the stakes. The risk is shifted from the institution back to you, the individual. And it explains why underwriting might be slightly less strict in recourse areas. Because the lender's ultimate security isn't just the house, it's your entire financial future.
Okay, our last safety net mechanism, mortgage insurance. We touched on it earlier, but let's be crystal clear about its role. Who is it actually protecting?
This is probably the most common point of confusion for new homeowners. Mortgage insurance, or MI, protects the lender, the mortgagee. It does not protect you, the borrower, the mortgager. It is an insurance policy the bank takes out against you defaulting.
And it's almost always required when that key risk indicator, the LTV, is too high.
Correct. The standard is that it's required for any loan with an LTV over 80%. The lender sees that low down payment as higher risk, so they insist on an insurance policy as a hedge. And while the lender is the beneficiary, you, the borrower, are the one who pays the premiums.
Usually as part of your monthly payment. But it doesn't last forever.
No, and getting rid of it is a great way to lower your monthly costs. It can be canceled once your LTV drops below 80%. That can happen either because you've paid down enough principal over time or because your property's value has gone up significantly. It's a crucial buffer for the lender against having to sell a hard asset quickly at a loss in a down market.
This has been a huge journey. We've gone from the etymology of a medieval pledge right through to these incredibly complex modern financial structures all over the world.
It's a huge spectrum. We've seen the precise math of the amortization formula and DTI ratios and contrasted that with the blunt political force of Canada's mortgage stress test. We've explored the cultural accommodations made for Islamic finance, solving that tricky stamp duty problem.
We started by calling it the death pledge, and that name reflects that finality, either fulfillment or foreclosure. But this whole discussion really reveals this fundamental tension in modern societies, doesn't it? It's this balancing act.
It is a balance between the efficiency and security that lenders demand, which is why we have LTV rules, strict underwriting and recourse debt, and the public's desire for widespread homeownership, which is why governments create things like Fannie Mae or the 30-year fixed loan.
The entire structure of a mortgage is really a negotiation between financial stability on one side and accessibility on the other.
Absolutely. And that leads us to our final provocative thought. In a world of increasing financial complexity, where your loan can be packaged, sold, and owned by investors you'll never meet, and where the risk you bear is dictated by the laws of your state or country, who truly bears the ultimate uninsurable risk of the mortgage? Is it the institution that lends the money, or is it the individual who makes the pledge?
A question that shapes national economic policy and, of course, our own personal well-being. Thank you for joining us for this deep dive into the world of mortgage finance.